Welcome, everyone. Thank you for joining us today. I'm August Biniaz, co-founder and CEO of CPI Capital. I'm joined by 𝗖𝗽𝗶 Benesocky, co-founder and vice president of CPI Capital. Welcome, Ava.
Thank you, August. Thank you. Hi, everyone. Thank you for joining us today. Today's an exciting one. We are joined by John Grace, president of Investors Advantage Corp, to discuss the U.S. economy post-election and what's right around the corner for real estate in Canada and the U.S.
Great. Absolutely. I love that. The Investors Advantage Group. What a perfect name.
Yeah, right? Investors Advantage Corp. That is like very powerful, John. Very powerful.
Thank you. Appreciate it.
So, you know what? I'm going to go ahead and introduce John.
Please.
Okay.
Yeah, perfect.
So, John Grace is a professional with over 30 years of experience.
He's had more experience than you've been alive, Ava.
That's true. Okay. But here are some of his accomplishments and credentials.
Absolutely.
Just to list a few. John is an author, keynote speaker, past and present board member, and trustee of many associations such as El Camino College, California Lutheran Educational Foundation, American Heart Association, Westlake Village Chamber of Commerce, and many others. Due to his knowledge and experience, John is a frequent lecturer on financial matters and has been retained to conduct workshops for colleagues, corporations, and various colleges, universities, and adult education programs. He is also co-host of a new radio show on Voice America called Fiscal Finance with John Grace and Daniel Mendina.
Awesome. Great. No, absolutely.
And you know what, John? I want to start off with your book here, your amazing book here. August and I had a chance to have a read, and we must say it's full of golden nuggets.
Absolutely.
So everyone, please get on Amazon and make sure you order a copy. But most importantly, leave John a 5-star review.
Absolutely.
Because he took the time to be with us here today.
And I just shared the link to the book on Amazon. Please get on there. Also, I shared John's LinkedIn page, so get in contact with him. Also, the Westlake Financial Advisors website. So please get on there and get in touch with John. Also, another great item that John mentioned right before we started was that if anyone has any questions, please put it in the Q&A box, and John will send you a Kindle version of his book, totally complimentary. So there's some golden nuggets before we even start.
Very nice of you, John.
There you go. Great. So John, how about these elections and what's happening here? I mean, it was a roller coaster. Me and Ava were watching it go on last night, and Ava literally pulled out some popcorn.
Yeah, we were watching the elections last night like it was a thrilling movie. We were just like had popcorn going, and it was quite time.
Well, yeah, it certainly has been a roller coaster ride, and I'm afraid it's not over. But let me just say a couple of things real quick. Happy to send you the Kindle version of my book. I'll need your email address, of course, to do that. So that's important. And this is no cost, it's a gift. It's Thanksgiving, so it's a time to give back. The other thing is our show is Fiscal Fitness on Voice America. And by the way, seeing as we're moving into the space, well, I'm sorry, we'll get to the election, but we're moving into the space of Thanksgiving, at least in the US of A. I want to point out that Investors Advantage is now offering free financial planning for all frontline workers. I mean, these folks put their lives on the line every single day. And I so appreciate that. And yet I'm scared to death for them because they do not have the luxury of being able to work from home. They have to show up, particularly the healthcare staff, right? From peak to trough, from high to low. So what we want to do is say, geez, thank you so much for taking care of us. Now let's see if we can help you take care of your money so that you don't run out of money before you run out of time. So yeah, with that, we're still waiting for the election results, and looks like we've got Georgia, Wisconsin, Michigan, North Carolina, and Pennsylvania that have yet to finish counting their votes. Now, just to kind of put things in perspective, we have been here before. And this is something to observe because I believe the last time it was a situation between George W. Bush and Al Gore, and that was in 2000. And when there was not a clear indicator of who the winner was, the S&P 500 declined about 5% from November 7th, that was election day of 2000, until the decision was decided by the Supreme Court on December 12th of 2000. So the markets you can make money in a good market, you can make money in a bad market, but it's hard to make money when there's a whole lot of uncertainty. So hopefully this will get done before the end of the week. If that does happen, I think we'll see more of a melt up in terms of markets hitting highs again. If it takes longer than that, then I'm afraid we're sliding into a meltdown. And at some point, we should talk about what people can do, because everybody enjoys making money when prices are going up. Real estate, stocks, municipals, doesn't matter, right? You feel brilliant, like it had something to do with intelligence. That's really called luck. But when it declines, and particularly when it declines past your acceptance level, that's when you really start pulling out your hair and going crazy. And you don't want to do that when you could avoid it. And the truth is, in some cases, you can do better to avoid those severe losses.
Yeah, no, that was a great point. And what you mentioned about the uncertainty, what it does, it brings the markets down. But now the markets are doing really well currently. They're on their way up. Is that because it's kind of the results might be more obvious than they seem?
I think so, August. I think the markets were expecting that we would have an answer really by now. So there has been more upward volatility. And as I say, to the extent that that just takes about a week or so, I think that might continue. But if it goes longer than that, and if there's some other, shoe that drops, that's when we could see things turn around viciously. And that's like we saw from February the 19th through March 23rd. Markets were off over 30% for that particular. That was in 33 days. The market was off over 30%. That's pretty significant. And I certainly saw some neighbors that I talked to frequently. These are folks well into their 70s, but it seemed like I came into 3 neighbors like back to back to back over that weekend, and I thought these guys were going to cry because they didn't give me the details. But clearly, whatever decline they saw in their portfolio was more than they were willing to be okay with, and they looked depressed, and then they ran back in the house. They didn't want to talk about it anymore. So that's what happens sometimes.
Yes. No, great. No, that's very true. I appreciate for that. So, kind of, what was your prediction for this? I felt as if if it was pointing more towards Biden, that the markets were going to take a hit, but if it was pointing towards Trump, but it seems to be the opposite now. Especially if the Democrats get into power, there might be more impetus to have some stimulus going back and allowing it. But the issue is that now I believe the Congress, is it the Congress that's controlled by the Republicans now?
Well, primarily, the Senate. Yeah, the Senate. It's 53 to 47, if I'm not mistaken, Republican held right now.
Yes. Okay. So and that might slow down any kind of stimulus that the Democrats try to pump back into the economy. Or what is your take on?
In terms of stimulus, I think you're going to see it. I think too many people want it. If it's a Democrat-controlled Senate, I think the size could be $2 to $3 trillion. If it is more like it is today, where it's primarily a Republican-controlled Senate, it might be $1 trillion or less. It's going to happen. It just depends on who's actually kind of driving the bus, if you will. And in terms of what the market is doing, I mean, I will always remember, I believe it was November 8th, 2016. That was the last election. And I would happen to be in San Francisco with many of my peers, and my peers for the most part happened to be Republican. And I had some friends from Argentina, and they were like, wow, what's going on here? Okay. And so what I'm saying is that night of the election, we thought that Hillary was going to win. But then I'm looking at the futures for the market, and I'm going, oh my God, the futures that night dropped 600, 700, 800, got to 1,000 points that was expected to open the next day. And so I'm texting my office going, okay, let's do, all right. And then we wake up in the morning, and guess what? All the clouds went away and the market took off from that opening the very next morning. So that's why you have to be very agile as an investor. Do not let your ego get in the way, because sometimes you make rash decisions, or you're convinced it's going to play out like this, and it doesn't, it plays out like that. And you're left holding the bag, or you missed. So many people saw the declines sold that night or the day before did not see that gain the very next day. So agility is so important, kind of like we want to be palm trees in Hawaii, right? We just wave and flap in the wind. We might lose our fronds, but we're still intact as opposed to be completely unrooted.
Great point. Great point. Eva, if you'd like to quickly ask this.
Yeah, so John, even though it's not 100% confirmed, but it's pretty clear Biden might win, please tell us what effects will this have on the US economy, especially since we help Canadians invest in the US?
Yeah, I think you may see kind of a shift. I think some of that's been happening. The markets did expect to be more of a blue wave, so that's interesting. That doesn't look like that's going to happen. But I think you've seen some softening, at least for a while, in terms of tech stocks. So I would say that President Trump plays better with tech, whereas the former Vice President Biden plays better with value stocks. So it'll be interesting to see who takes this lead and how that plays out. But things do shift. So you're definitely going to see probably more muted now, but tax increases, which I've been saying for a long time, have been way too low. And by the way, seeing as you guys have the perspective, unlike most of us, of being in different countries, you might go look at the happiness index. And what blows my mind is the US of A, with our experience and prominence on everything. We think we're so fortunate. Well, on the happiness index, we rank like 18th. And by the way, Canada, if I'm not mistaken, is 11th. And the top 5 are Nordic countries. Yes. So it seems as though the people who pay the higher taxes and feel that they're getting something for their money are happier than the ones who've been told, oh, pay the lowest taxes, pay the lowest taxes. But let's understand, that leaves your infrastructure at risk. It means your healthcare system is not as good as it could have been. It means that your educational system isn't as good. And one of the things I talked to some folks who migrated from the US, both PhDs, to Norway, they said, we know we pay more taxes, but you know what? We file and we are done. We do not need a CPA. It's so simple. When we want to take the family, it's not like going to Disneyland. We have to hawk the house to get enough money to pay the tickets and feed the people, and then you're whooped. No, we take the subway. It's free, it's clean, it's safe. And then we get to the park and it doesn't cost us an arm and a leg to get into the park. We like life like that. So some of the things I think has to happen is that we really reevaluate what's important to us, change some, or at least look at some of our priorities, as opposed to accept some of the, pablum that we've been fed, and we just suck it up because that's what they're saying, paying lower taxes is the best thing ever. Maybe, maybe not. But notice that, as again, we're 18th out of 155 countries. We're barely in the top 20.
Yeah, no,
very good point.
Great point. No, absolutely. So if you like, maybe we can kind of ask John about our next question here.
Yeah, for sure. So John, what should we expect when it comes to real estate in the US and Canada moving forward?
What can we expect when it comes to
real estate?
Real estate.
Real estate. Okay. All right. Well, here's where, to me, it gets fascinating because like I was talking to a very good friend of mine who runs a very large operation in Malibu, California. And he says, John, I've been in the business for 40 years. I've seen everything. And I said, Ken, actually, you've seen the best of times. That's all you've seen. Let me say it to you this way. Being in the business 40 years, you enjoyed 76 million people coming into this thing called these United States of America. Now, let's recognize it's the only country where 76 million people have showed up. It only happened once. And I don't see it happening again. And let's recognize, this is a scientific term, what caused the baby boom generation? And scientifically, we'll call it pent-up demand, all right? So you've got these people, these guys coming back and they see their wives and here we go. All right, 76 million people from 1946 to 1964. So I would submit that if you have 76 million people, not counting the immigrants, because we benefited from that, like Penn, we had both 76 million people coming into the equation, and then we had people immigrating into the US. I mean, we benefited from both. So it makes sense to me that prices are going to go up when you have that kind of demand. It also makes sense to me that sometimes we get into a frenzy, and things have gone bonkers. And the first example of that, we can go back to the Netherlands in 1634. And lo and behold, if you had a box of tulip bulbs, that was enough with which to buy an estate. Huh? What? That can't be true, but that's our history. We call it modern history. And then about 1637, the price of a tulip bulb reverted back to about the price of a lemon. It just blew up and it blew away. So all I'm saying is, let's notice that sometimes we get into these frenzies and we put more and more helium in the balloon, but every 7-year-old knows, no matter where they live, that the bigger the bubble, the bigger the burst. So what I'm saying is, let's look at it this way, in a very fundamental way. So let me say it first step. Here's the question. What age did you consume the most potato chips in life? According to the Census Bureau, Americans consumed the most potato chips in life at age 14. Now, I can go back to middle school, and I have to tell you, when I read that, I'm like, wow, every day I had to have Lay's barbecue potato chips. And on the weekends, it was 2-3 bags of these chips. I could not live without those chips, okay? So let's just notice, we all think we're different, and we are, but in many cases, we're following the same pattern of the people who hit that age and fall into the same kind of situation, all right? It's just a pattern. Okay, so then if we look a little further, guess what? The age at which you bought the most potato chips in life in America was about age 41, 42. When, guess what? You had an average 14-year-old in the household. So that means you had to buy all the potato chips you could to satisfy these cravings of these kids and their friends. And now you're past that and the kids are out of college, and maybe you buy a bag of potato chips for Thanksgiving or Christmas, but you're not addicted to eating them like there's no tomorrow. So this is how basic some of this is. And it helps us get a bigger picture. And that's why we've been paying for independent research, because it helps us see what's going on in a larger way, as opposed to just looking at sales or inventory or interest rates. Those aren't the primary drivers. Here's the primary driver. It's looking at the consumer's activity based on age, like the potato chips. Okay, so when it comes to residential real estate, 31 has been the age at which most Americans have bought their first house. Now, millennials, it looks like it's slipping to 37, but it's in your 30s. And go back and look to see how old you were. And guess what? You may find, oh my goodness, somebody had a GPS on my butt, and I was 30, 31, 32. I happen to be 24, but that's only because I had a godmother who was a realtor. She says, you have to buy a house. Okay, I'll do it. Okay, and I did. So 31's the first one, first house. 41's the second house, which also turns out to be the largest home. And from 1980 to 2000, 40% of all the homes purchased in the country were on lot sizes of 1/2 an acre to 10 acres in size. Really? And okay, let me look at myself and go, geez, as I was turning 40, I could not live without a 5,000 square foot house. I mean, I just had to have it. 6-car garage. Used to go out and count the garages, right? Just because I thought that was so cool. I had 4 cars to put in the 6-car garage, so this isn't bad. And then, so that means that the boomers were doing what everybody else was doing at exactly the same time over a year period, buying the biggest house they will ever own. So first house 31, biggest house 41. What's around the corner? Everywhere we look, the only thing we're hearing is how people are stepping up because of COVID to buy a house. They're stepping up to buy a house because interest rates are the lowest they've ever imagined or didn't imagine. But what I'm saying to you is, here's what actually happens. 78 is the age at which most Americans sell. 78.
78, okay.
Right? And boomers are now what, 55 to 74, again, born 1946, 1964. So we're just about 4 years out from, at least according to the Census Bureau, falling into a different pattern of selling at the same time. Now, excuse me, why is that important? I think the good news is, when it comes to the Great Depression, more Americans became millionaires than any other time in history.
Yes.
So if that's the case, to me, that's very good news, which goes to say, even when things go awry, turn upside down more dramatically than you ever imagined, there's still a way to make some money. But sometimes it means getting the cash from the properties or the assets that have risen to a value that you never imagined. So then you sell high, don't buy anything in the same domain like residential real estate. What you might want to do, or if you don't care where the prices go, Ava's not 30 yet. So if you don't care where prices go and you want to buy a house, I would say buy one. But if you care about prices where they might go, you might want to keep your powder dry. Because let's see it this way. How many times, I'll ask you both, how many times have we seen any country where 24% of the population went to heaven?
Went to where? Heaven? 24% of the population went to heaven.
You answer this one, August. He's on the hot seat.
We haven't seen it.
Yes.
We haven't seen. There we
But
go.
76 million is 24% of the population. So when my friend tells me I've seen everything, I'm going, you have not seen that.
Oh, I see. Okay.
Because it hasn't happened before.
Right.
But now you tell me what you think. When 24% of the population disappears over a 20-year period, it'll take that long, and the inventory stays exactly the same for the last 130 years of construction in residential real estate, when the demand goes to heaven and the supply remains the same, what do you think prices might do? I don't think this needs rocket science. I'm suggesting they could go to hell, along with RITs. So that might be one of the reasons you want to capture the gains that you can, why they are at these levels, and then get ready for the next opportunity, because there's going to be a huge opportunity. But before we see the next gain, we're going to experience some pain. And let me put it in perspective in two ways, because on so many interviews, they're asking, how soon are we going to see a V-shaped recovery? And I'm like, well, I don't know. But if we look at history, I can see two L-shaped recoveries. Well, the first one would be in the US of A. That would be the Great Depression. And if I'm not mistaken, it took stocks about 20 to 25 years to get back to even. That means you saw $1 million drop to 108,000 in about 30 months. And then it took 20 to 25 years to get back to even, because the securities industry has always told you the market always comes back. Well, we'll come back to this in a minute, but let's look at the next shoe that falls. A year later, guess what happened with New York real estate? New York's always been the capital of commerce, right, in the world. And we saw a 70% loss in New York real estate. So imagine your million in stocks dropped to 108,000, your million in real estate dropped to 300,000. You were the $2 million person or couple, all right? And now you have all of $400,000. Have a nice day. But let's keep this in mind, because see, this is one of those things that we just aren't trained to look at, the buying behavior of people and the life expectancy of people. So if you were an adult in the early 1900s, your life expectancy is about 57. So if it took, clearly you were an adult to have $1 million in stocks and an adult to have $1 million in real estate. So if it took 20, 25 years for your stocks to get back to even, assuming you didn't sell a share and assuming you didn't take any money out for 20, 25 years, that sound logical to you? Realistic to you? The prices came back long after you were pushing daisies. That was true for stocks. That was also true for real estate. Real estate in New York City took 4 decades. That's right, 40 years to get back to even. So that's the first L-shaped recovery. Here's the more recent one. In the late 80s, in the US of A, especially on the West Coast, we were convinced that Japan was going to be #1 in gross domestic product. No question. And then we were cool about it. Okay, they got the flag, the sun with the flag on the flag. Okay, go enjoy yourself. Who cares? That did not happen. I'm going to submit to you basically for 2 reasons. The 2 reasons we're talking about. They did not enjoy, like the US, a baby boom of the same size or even close. And they did not enjoy any immigration. None. They never have. Now, let's notice that the Nikkei 225, which is probably the equivalent of our S&P 500, if I'm not mistaken, year-end 1989 was about 39,816, if I'm not mistaken. That's where it closed, 39,816. I looked, this is Wednesday, so it might have been yesterday that I looked. I noticed that the Nikkei was at 23,700. Here's my point. They have not seen 39,000 since 1989.
Wow.
That's now 30 years. Imagine not seeing the gains that you were, the level that you had, that you took for granted 30 years ago. All right. And then guess what? About a year later, their real estate market dropped, sound familiar? 70%. And I found one source, I was on a show like this, and oh, look, this source suggested that they thought Japanese real estate would get back to its high in 2021. That article was written in 2017. Well, that was before COVID. The point is, regardless of what's going on, neither the stock market in Japan nor the real estate market in Japan have gotten back to the levels, to the highs. So now we have two L-shaped recoveries that took longer than anybody ever imagined. And notice again that the industries always say, oh, it always comes back. Yeah, well, maybe after you're long gone. So that's, again, my point is, let's do what Hugh Hefner did when we can. I mean, he had the Playboy Mansion and he decided that he wanted to sell it. I think he was well into his 90s. And he decided that the price that he wanted to enjoy selling at was $200 million. And from what I understand, he never got anything close to that price. Notice most of us go, oh, I have to get my price. I have to get my price. I can't give this away. Well, some people would say he gave it away for $100 million. Here's what I look at. Can you imagine the satisfaction, the pure joy of having $100 million in your hands to do wherever the heck you want with while you're here? Nobody's going to fight over it. Nobody's going to argue about it. And you're able to give it to the people and the causes while you're here and get real joy out of that money in terms of being able to deploy it in ways you've never been able to do in your life before now. That sounds like fun to me.
That sounds like fun.
Absolutely. Oh, great. That's great speech. We have a quick question here for you, John. So we got a winner. The first book goes.
All right.
Go ahead, Ava, if you like.
Okay, so thoughts on if this drags on past 7 days.
We're talking about the election
market, yeah.
Market up or down, or do most investors have plans either way, so they're investing regardless? Hence today's market jump.
Yeah, let's say this: no one can see the future. And my best line is, it's not about the prediction, folks. It's about the preparation. So do not try and imagine what's going to happen and vote or put your money on red or black accordingly. Here's a better question I would ask you. What kind of loss can you live with? Okay. That's a great question for investors to reconcile. I don't care if you're conservative, moderate, or aggressive. I don't care your age as much as I care about, have you been through a 50% loss? And many investors have been through 2 in the same decade. Who was prepared for 1, let alone 2? Now, if it were the case, hypothetically, that you could have kept your losses during those 2 50% declines, 2000, 2002, 2007, 2008, let's say to 20% or less. When we get to a 50% decline, what do we need to get back to even? 100%. By the way, if it goes to 60, it's 150%. Do you see how that bigger hole makes for the reversal certainly more challenging? But if we could limit the loss to, let's say, 20% or less, if it's as much as 20%, the gain's only 25 that you need to get back to even. Now you're still in the game as opposed to hoping that the prices come back, or you've got to throw a Hail Mary pass just to get back in the game. So I can't tell you when or how severe the declines might be. I would not be surprised at some point that we see this market reverse itself very severely. And by that, I mean, I wouldn't be surprised if we saw a retest of the 30% or more loss we saw in the first quarter of 2019. I would not be surprised, you know, Michio Kaku, PhD, if you've never seen him, go look for him. He looks like an astrophysicist, and he is. I had the occasion to meet him, and what he said is, in the studies that he's done, depressions occur every 80 to 90 years. So if it is the case that you think that might be something that happens, it becomes even more important. Don't become complacent. Don't imagine what you could do. decide how you will set your account up so that maybe one, you know what kind of loss you can live with, and two, whether or not you can see the evidence that the account, let's say in 2008, performed within your specific loss parameters. So if the market's off first quarter 30, 35, whatever it might be, but you're only off 8 to 15, whatever it might be that you could live with, now you know, okay, if I'm off 15, I need what, 17? Okay, but if I'm off 40, now I need 66 and a half. That to me is the question that people should be wrestling with. And unfortunately, the securities industry doesn't really assist us in this. The only message we've really conveyed typically and very effectively is buy and hold no matter what, buy the dips. That's the message that we've conveyed. That might work when you're Ava's age, okay? Let's look at it this way. If you were 70 and a half in America and you retired in 2007 and you wanted to start taking, you rolled your 401k into an IRA January of 2008, and you only took out 3%, 30 grand. We'll all agree that's a very low withdrawal. But then that market hurricane, which you did not expect, went from peak to trough off 57%. So that means $1 million minus 570,000 plus your 30,000 that you took as a withdrawal. That's 600,000, right? $1 million minus 600,000 is 400,000. Are you having a nice day yet? And let's recognize with traditional retirement accounts in America, every year for the rest of your life, you have to increase your withdrawal no matter what your account value is. So your ability to buy and hold has suddenly changed, and it will never go back to the way it was. Every year, you have to take an increased withdrawal from your traditional retirement account, like at 92, 95, somewhere in their neighborhood. I think the withdrawal rate the IRS requires is 11%. So the point is that, if we could limit the drawdown, that would be the combination of market loss and withdrawals, again, to let's say 20%. Now we need 25% to get back to even. That might happen. But if we find out how low we can go, kind of like 𝗖𝗣𝗶𝘁 and Roadrunner, right? Where they're running off the road and then they just stand in midair and we're all watching what's going to happen. We know what's going to happen. And now they're asking, how low can we go? That's what I want people to avoid. That experience of how low can we go. Let's figure out I can live with a 10% loss. And look, I can see the evidence that this account's never been off more than 10, or maybe it's 12, I don't care. It's still within my parameters. But once we get past 30, 40, 50, 60, oh boy, it's ugly. Mm-hmm. And if you're 70, geez, that was a 60%. We need 150% gain at 70 years old to get back to even. What do you think your odds are? They're not good.
That last question was from Bridger Pennington. And if you could share your email address, we'll sure to, I think John gets to see it and we'll send you a copy of his book. Yeah. And I happen to see Bridger's advertisement on YouTube every time I'm there. So how you doing, Mike? Hi, Bridger. Thanks for joining. We're happy to have you on. So we have another question if you like. All right. Eva. I think John can see it as well, but go ahead.
Okay, John, here's another question. What about commercial real estate values since COVID forced people to work at home?
Yeah, let me say this, that everybody's talking about how things can get back the way they were. And sometimes I'm submitting that this pandemic is a disaster of epic proportions. It has changed everything right before your very eyes. And we don't even see how it has changed so much. What people tend to do is we get very comfortable with what we think we know. And I was listening to one of the pandemic doctors, and I thought the way he put it was just brilliant. He said, the problem with optimism is that it breeds complacency. So when I look at client portfolios, like we work a lot with engineers, and this gentleman has been a client since he was all of 14, eating all the potato chips he could, by the way. But now, he's mid-50s, and he says, well, I'm a conservative investor. And I go, well, I hear you, but you have two statements here that are telling a different story. You have $5 million worth of real estate, and your investment portfolio in stocks and bonds is 85% stocks and 15% bonds. So I just want you to know that while I want to believe you, I actually believe your statements. This is an aggressive account.
Nice.
Now, when we look at some of the institutions and the endowments and the foundations, Yale, for example, well, okay, let me ask you a question. You, August and Ava, any number will do because you haven't looked, so, but it's healthy, I think, to kind of have these discussions. What do you imagine? I believe the last number I saw, Yale Foundation, $29.4 billion. As a percentage, well, we'll start with real estate. What do you think Yale has in real estate, approximately?
They have in real estate all their assets. This is like the endowment? Or,
yes.
Okay. I would say the ratio compared to all of their investments.
Yes.
I would say their ratio is probably, hopefully, 20%.
Okay.
I would say 40%.
That's
40%. All right. Last I looked, if I'm not mistaken, it was 11.
Okay.
Okay.
I'm way
Okay.
off.
So what do you imagine Yale Endowment has in US equities?
Okay.
I'm not sure. I'm not
John,
sure.
teach us.
3%.
Wow.
3%.
3.
Okay.
And they reveal their report once a year, and I have to go look at it every year. And guess what's been happening over the last 10? Each time I go look, they've lightened up on US equities. Huh. Okay. So what do you think they have in corporate bonds as a percentage?
Corporate bonds.
10%?
10%? Sure.
Okay. Last I looked, it was 4.
Oh, okay. Okay.
All right. So let's just notice the securities industry, and probably certainly in the US and in many countries, suggests that you are diversified when you have 60% stocks and 40% bonds.
Okay.
Now, we might call that a two-legged stool. So the first thing I notice at Yale is how their exposure to those traditional assets is vastly different. I'm not saying it's right. I'm not saying do this. I'm just saying notice how they are doing something so vastly different. That's the first thing. All right. And then the second thing I notice is I count 7 legs under their portfolio stool. 7 different places they invest, not 40, 50, 60, 80% in stocks, not 40, 50, 60, 80% in any real estate anywhere. 7 or 8 different asset classes. And I think the largest holding, if I'm not mistaken, might have been venture capital, and it was less than 20%. So I'm just saying, notice there aren't any big bets, number one. Number two, notice that they've got a lot of legs underneath the stool. So for example, in 2008, most people said, geez, my house got hurt, my bonds got hurt, and my stocks got crushed. If we had the ability to recognize some of them are liquid mostly, but some of them are illiquid, commodities and currencies, for example, we saw quite a nice gain in 2008. That's my point, that sometimes by virtue of having more diversification, that we may have a surprise somewhere that we weren't expecting it. And if the market's off, 37 for 2008, but you have a position that's up 38 in 2008, net, whatever it might be, you're kind of go, okay, this isn't so bad. I can get up tomorrow and smile. But when the account looks like it just went down like the Titanic, it's hard to have a nice day.
No, great.
So sorry for the long answer, but I'm just trying to say there's no real easy answer anymore. And I'm also saying do not get complacent with whatever you think is going to happen. My 1-2 punch is diversify unlike you've ever diversified before. Maybe you have a domain in commercial real estate, but keep your bet smaller than you might have had in the past, particularly what's going on and the uncertainty that we know is happening right before our very eyes. Diversify, or have some, maybe that's what you do, and you have other people do what they do in their domains, and that way you might have a smoother ride. So diversify unlike you've never diversified before. And then what I'm also suggesting is that investors put in active management strategies, so that let's say in 2008, when we're looking at grandpa with this $1 million, for most of us, the account started with 5% cash, stayed 5% cash, 95% invested for all of 2008 through March 8th, 9, 2009. But what the systems that we like moved from 5% cash to 50 to 100% cash. In other words, instead of holding shares and watching the price go down like that Titanic thing, right? Never saw light at the end of the next day. These systems move the money off the table, out of shares into cash. Hard to get hurt in cash. Can't get any gains there, but you're not going to get here. It's a place to be safe. So what we want to see happen is when the market goes nasty for whatever reason that you did not imagine, all right, the systems automatically look at your account every day. And the question is it risk on or risk off? Are we putting fuel on this fire or water? So in '08, we wanted to put water on the fire, move out of shares into cash so that the ratio was started at 5, finished the year 50, 60, 70, 100%. 2009, starting March 9th, 2009. Now it's pedal to the metal. So we want to move out of safety into risk assets and get that level to back where it was, so that maybe it's 95% invested eventually, or at 5% cash, to limit the losses in '08 and enjoy all the gains of '09. That to me is the 1-2 punch. So let's diversify, and let's make sure we have every place we can active management strategies in place so that these folks will respond to what's going on. It's not market timing, but it is looking at the volatility every day. And as I say, think of the movie Karate Kid, wax on, wax off. So in '08, we wanted to wax off, get off the tracks. In '09, double down. It's wax on, baby. It's pedal to the metal. Put the money back where it was. Let's see all of these gains. That's the way we like to suggest to people to invest who are worried about what kind of declines might happen. I mean, let me say this to you, that if we wanted to jaywalk across the street to go to lunch, it's typically not the bus we see that can disrupt our day. It's the bus we didn't see, we did not time, we did not name, and hopefully we can pull ourselves up off the pavement and take a picture and take down the license number. Otherwise, we're dead in the water. And that's part of what really drives me when I look at what happened with the Depression. I can only imagine if you were affluent and you saw these gains, and for the most part, your real estate in New York and your stocks in the US did not come back to even in your lifetime. I think you probably died with regret.
No, that's true. And John, let me ask you a quick question on this diversification topic. What would be that sweet spot to have as far as your real estate and kind of market investment? Obviously, putting aside your primary resident, but on that investor's kind of sweet spot, what would be that percentage between investing in the markets and real estate?
So I would say if you look at like Yale versus Harvard, I think Harvard's larger, their endowment, their investment strategy is vastly different. What I'm really trying to say is it all has to be customized. I don't have a template for folks. All the work that we do is customized, but we want to keep things safe and simple and strong. So we want to help you discover what kind of ratio you can live with. As I say, when we ask this question about what kind of loss you can accept, what we sometimes do is take your current portfolio, run it backwards, so that as one couple in Hawaii, they did not know that when the market was off 37%, their account was off 42. Really. And now they know that they could live with an 8% loss. So for their aha moment became, oh, gee, well, we're back to even, and we've got some more since then, thank God. But now we're getting ready to start taking withdrawals. We can't do that again. So our loss limit is 8%. And then, if you can design a portfolio where you can go back to look to see how it performed at the same time frame, and it didn't do as badly, or maybe it was even less than the 8% that you said was okay. Now you know I can live with this. If it happens like this again, and of course there's no past performance, there's no guarantee of anything in the future, but at least I can see that it might perform within maybe this kind of a range, as opposed to me trying to go for that Hail Mary pass.
Great. Yeah, we have one more question here for you, and I'll have another question at that end. We can at that time probably get to wrap it up.
All
because
right,
John has
John
spent
is,
a lot of time with us.
All right, John, what could be the impact on tech stocks with a Biden presidency?
Well, tech stocks they're not going anywhere. They've just had a heck of a run, and they probably will continue. But let's see. Part of what concerns me is even with right now we're seeing the Dow do very well because of value stocks. Yesterday, the S&P was doing very well because of tech stocks. So what I want to make sure people recognize is be careful of just seeing the top 5 names, because we may be at some point back to where we were 2000, 2002, where it was the top 10 companies or the ones that were growing the most in prices per share, right? But then they reverse themselves so viciously. So what I'm saying is, look at the breadth of them. That's a D, right? Look at the volume of the market. Don't just look at where the market closed or which stocks did well, because when it's light volume, that's not good. When it's a lot of volume, that means there's a whole lot of participation. That certainly is better. So tech is not going anywhere. Healthcare isn't going to go anywhere. Green energy, I think, is going to be a good place to be. But again, let's diversify, because it's so easy to feel good when something's going up and so bad when things go down.
Diversify.
Absolutely.
Yes.
We gotta call John the king of diversification.
Yeah.
Maybe one more question, and then I'll get to mine.
Sure.
Okay, what are your thoughts on the impact of Biden's policies on long-term investments? Which investment avenues to focus on for retirement plans?
I don't know. So what I would say is, I'm not sure that's an answer that really, frankly, matters. What I am saying is, we again, the diversification. There should be exposure to things that, as I say, if you have an interest in one area, we're in an area where Amgen is huge, okay? And what I say to particularly employees at Amgen is, if you like the company, let's own the space. I don't want you to have 30,000 shares of Amgen. If you like biotech, let's buy the biotech companies of the world. Now, you may have maybe a little more exposure to Amgen, but I can't tell you Amgen's not going to turn into Enron. So what I'm saying is, we can like the space. And if we do, let's not put all our eggs in one basket. Let's diversify, as I say, the biotech companies around the world. That way, the chances of something turning ugly is just less.
All right.
That's a great point. So
Why don't we finish up with your last question?
Yeah, it's not really a question. It's more of a point and somewhat of a question within it. It's so when we kind of look at the U.S. market and our interest in wanting to be involved in the U.S. real estate market, we basically follow the numbers. We see the interstate migration that's happening. People moving out of California, moving out of New York, moving to lower tax states like Texas, Arizona, the Carolinas, Georgia. So, because of that interstate migration, it's creating new markets within itself. So we were comparing to Japan, very small country, obviously, certain issues with the aging population. But in the US, you have this interstate migration and movement and markets that are created. So that's one point I wanted to make and kind of get your input on it. And also in regards to the baby movers and not baby movers, sorry, the Generation X and the millennials. They seem to be, and this is again on data that you were mentioning, they seem to be very subscription-based kind of generation, where they know how much they make this month. This percentage of it goes to their rent. This percentage goes to fund. This percentage goes to food and investment. So they are very much kind of they're not like their parents. They don't want to own real estate. They look more forward to renting. So kind of give us your thoughts on those two items: the interstate migration and the millennials wanting to rent more kind of aspect.
Okay. Yeah, no, your observation is spot on. The boomers had no problem with living in a very nice house in a nice community, and dad driving back and forth an hour and a half to go get the money. And the kids are going, wow, dad, this is kind of crazy. You go to work and it's a hassle to get back and forth, and you bring the money to the house and you wash the cars, you mow the lawn, you wash the windows. It's all for a house. Who cares? I don't need a damn house. Okay. So things change, and that's part of what we have to be cognizant of. And let's also understand, regardless of what we buy, I think every country has followed the US from the standpoint, for many of us, it's spend, baby, spend. Bad habit. Look, if one couple, this is an example, she's 30, they're both 35. They're making 100,000. I think, as I recall, 60,000 is being made by the wife, 40,000 is made by the husband. Here's the first thing you need to do. How much money are you wanting to have when you are going to make work optional? Please figure that out. Don't just buy stuff and if it goes up, feel good. What's your target? You don't get on a plane and just wander around until the plane runs out of fuel. You don't do that in a car either. So you figured out, this is point A, I want to go to point B. How do I get there on time safely? So this couple, 35, they're making 100 grand. And after accounting for a modest pension and some Social Security, we can see that their target is $2.6 million. What that means is at 35 by 70, they want to have the equivalent of $100,000 in 2020 dollars. Now we're making some progress. And then we see that to get from here to there safely on time, it means setting aside 15% of their gross, 15,000 of $100,000. It's roughly $1,300 a month. If they make that contribution consistently, don't stop, and earn a 7% return consistently, by age 70, they'll have exactly what they're looking for, $2.6 million sitting behind door number one. And now they may be able to spend the equivalent of $100,000 for the next 20 or 30 years. That's what we want. What are you doing and why? What is your money trying to do? Have you designed what it needs to do so that you can make work optional on your time frame, okay? And then let's look at this. Two things. 47 in America is the age at which we tend to peak in spending. It's just one of those things, but we don't recognize that. So we just think everybody's going to keep spending the way they were. And look at it. When you're 47, you typically had kids in the house. You can't spend enough. And eventually they're gone. You're like, who needs all this stuff? All right. And lastly, here's a big aha moment, at least for me. And that is that if we look at the world, we are in unprecedented times from the standpoint that we have more people 65 and older in the world than 5 and younger. So this has never happened before. And when we think everything's just going to go back the way it was, no, remember, regardless of COVID, there are a lot of changes happening. And the COVID has just revealed even more of those changes or accelerated the pace. So don't just think it's going to be the way it was. Let's look to see where the next wave is. As they say, rather than residential real estate, if somebody said, well, if I wanted to do something, what should I do if I want to do in real estate? I'm saying you might look at healthcare some kind of a way, whether it's the stocks or the real estate. There's a number of ways to play that. But we know that, like I say, all these people are getting older. The majority of the world is, now 65 and older as opposed to 5 and younger. So it helps explain, by the way, why my friends from Argentina went to Italy for a wedding, and they have a 1-year-old when they got there for the wedding. And guess what they could not find? They could not find baby diapers. Because they don't have any babies. Who needs diapers? Oh, the old people need diapers. Interesting. So let's not look to see, everybody's going to have a kid. Look, I just looked at this. In America, it looks like the birth rate this year will be light by 300 to 500,000 as compared to last year. If we look a little further, we can see that condom sales are up, but the number of births is diminished. I don't think that's going to change. And I don't think that's not just here. That's something that's happening worldwide. People are just not interested in having the kids and all of that work that they have to do to take care of those kids and be helicopter parents for life.
John, you are the power of statistics.
No, and diversification. Another thing I noticed in all my years in real estate is people who are very real estate focused like us, they tend not to diversify, and that's their Achilles heel. So we're gonna make an appointment with John and kind of talk about our investments and diversify with John. So,
and people can also diversify their investments with Canadian passive
absolutely,
investing.
Definitely, for sure. But for alternative real estate investments, definitely, John, we really appreciated your time, all the wisdom, all the knowledge, especially on this day, which is the U.S. election, getting pretty close to getting the results. Hey everyone, thanks for joining us. Please get on Amazon and order John's book.
Making Finance Makes Sense.
And if you have questions, I'll make sure to send your emails to John so he can send over the Kindle copy to you. Thank you so much,
John. It was a pleasure. Thank
My
you.
pleasure. Good to work with both of you. Look forward to doing so again.
Absolutely.
Wonderful.
Thank you.
See you soon.
Bye-bye.
Bye-bye now.